In the United States, inflation has re-accelerated even as growth forecasts are being revised lower. This divergence has placed the Federal Reserve at a difficult juncture. While inflation warrants policy caution, weakening growth has led to rising calls for a dovish shift. Globally, most major central banks have already pivoted toward rate cuts to support activity. Yet, despite this easing trend, long-term bond yields in many markets have risen, reflecting persistent inflation concerns and reduced bond buying by respective central banks. The dollar index recorded its steepest first-half decline since 1973, but the Indian rupee has diverged, weakening approx 3% while most peers strengthened. This recent underperformance resulted mainly from evolving trade frictions, FII outflows, and earlier resilience shown by INR. Trade tensions remain another key headwind. Newly imposed tariffs along with penalty have left India facing one of the steepest effective duty burdens among Asian EM peers, threatening export competitiveness in several sectors. Even so, volatility indices in both India and the United States remain subdued, suggesting that a significant portion of this uncertainty may already be priced into markets or no significant risk in the near term. On the domestic front, however, India's fundamentals remain resilient. Declining interest rates, persistent low inflation, improving rural wages, and tax measures are expected to support household consumption and private demand. This provides a counterbalance to external challenges. We expect upcoming festive season to be critical to watch from economic revival perspective. From flows perspective, DII's flows remain strong as equity MF saw record net flows approx 42,000 crores in July. However, the rallies have generally led to an increase in equity supply also through IPOs (OFS), which has at times capped upside momentum. The temperature gauge index remains in the fair value zone. Global markets have remained quite resilient amid tariff-related uncertainty. Most of the global equity indices are trading near all-time high, indicating renewed investors' appetite, while impact of tariffs on growth remains to be seen. Back home, the recent US tariff measures on select Indian exports could have a multi-layered impact. This could modestly weigh on GDP growth through weaker external demand and reduced manufacturing output. Otherwise, domestic demand is likely to be boosted by declining lending rates, tax cuts, sustained low inflation, and improved rural wage growth. From flows perspective, while FIIs turned negative in July, domestic inflows remained strong. However, momentum pickup in the markets also led to increase in supply of equities as well, and that has kept the rise in check. Nifty index is trading around historical average on 1-year forward basis. However, valuations in mid and small caps continue to trade at a significant premium, reinforcing the need for selective participation. Given supportive structural trends but heightened near-term uncertainty, we recommend to stay the course, anchoring investment strategy on India's structural growth drivers while navigating near-term volatility with discipline and selective positioning. Equity portfolio allocation stance, neutral with 65% allocation to large caps and 35% allocation to mid and small caps. Investment strategy, lump sum investments in hybrid funds at current levels. For pure equity-oriented strategies, a staggered SIP/STP approach is prudent given elevated valuations and higher volatility. Any sharp correction should be used for aggressive deployment. In fixed income, RBI kept the rates unchanged while maintaining neutral stance. However, Q1 FY27 forecasts CPI at 4.9%, GDP at 6.6%, suggests both higher inflation and growth ahead, limiting RBI scope for rate cuts. With forward-looking real rate around approx 1.5%, the 5.5% repo effectively serves as a tight real policy floor. Reflecting such concerns, long-term yields have risen in the last 1 week by 15 to 20 bps. RBI opts for a measured pause, remains vigilant and maintains status quo on rates with a neutral stance, while adjusting projections to reflect evolving inflation trends. Room for further policy easing remains limited and future decisions may be data-driven. Current scenario supports the case for maintaining accrual calls across the credit spectrum as the core strategy. Accrual can be played across the credit spectrum by allocating 45% to 55% of the portfolio to performing credit and private credit strategies, select in VEETs, REITs and NCDs. 30% to 35% may be invested in performing credit strategies, NCDs and select in VEETs, REITs. 20% to 25% may be invested in private credit including real estate, infrastructure strategies and select NCDs. 25% to 35% of the portfolio may be invested in arbitrage funds, minimum 3 months holding period, floating rate funds, 9 to 12 months holding period, absolute return long to short strategies, minimum 12 to 15 months holding period, income plus arbitrage fund of funds, minimum 2-year holding period. For tax-efficient fixed income alternative solutions, 20% to 25% of the portfolio may be allocated in conservative equity savings funds, minimum 3 years holding period.